Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe. Your deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills. And their hardworking employees can breathe easier as well. Last week, when we learned of the problems of the banks and the impact they could have on jobs of small businesses and banking system overall, I instructed my team to act quickly to protect these interests. They've done that. They've done that. On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. All customers who had deposits in these banks can rest assured, rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. The management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. There are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable. In my administration, no one is above the law. And finally, we must reduce the risk of this happening again. During the Obama-Biden administration, we put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd-Frank law to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again. Americans can rest assured that our banking system is safe. Your deposits are safe. Let me also assure you we will not stop at this. We'll do whatever is needed.
A lot of people are worried about their bank these days. While devastated giants like Citigroup get bailed out again and again and again, many smaller banks are failing. The federal agency that takes over unsound banks is the Federal Deposit Insurance Corporation, the same people who guarantee that depositors won't lose their money. Most every Friday now, the FDIC is seizing several banks. You haven't seen these takeovers happening because they're done secretly at night to make sure that there's no needless panic by depositors.
They're going to start at one branch, pull the cash out, take it inside of the bank.
This is a team of FDIC agents preparing to seize a bank outside Chicago.
What we need to do is we need to pull the corporate records.
They've checked into this hotel under a fictitious name, CB and Associates. To prevent a run on the bank, they don't want anyone to know who they are or why they're here.
In that moment, Operation Happy looked pretty grim.
Correct, because I would say a large majority of the employees don't know that the bank is in trouble and that it's about to close.
When the FDIC comes in and makes depositors whole at a bank that has failed, is that tax money?
No, it is money from our reserves, and we are funded by insurance premiums that are assessed on banks. So no, it is not taxpayer money.
We were told we would get in. Stay open an extra hour!
When IndyMac failed, you were watching these scenes on television of people lining up outside the bank like it was 1932.
Yes, it was.
What did you think of that?
So I think people just forgot that banks do fail and how the FDIC works. Their money was safe. It was safe. It was probably the safest place in the world to have your money because we were operating the institution at that point.
What sort of hit was that on your balance sheet?
I think we ended up it was over $9 billion for a $33 billion. Yes, it was very stiff.
The question becomes, How many times can the FDIC do that? At what point is the FDIC broke?
The FDIC is backed by the full faith and credit of the United States government. So if we need to, we try not to and don't want to, but if we need to, we can borrow from Treasury to make up for any shortfall.
So the FDIC never goes broke?
We don't go broke. No, we are the government. We're backed by the full faith and credit of the United States government.
There are three ways the FDIC takes over a bank. It can close it and pay off depositors, run the bank itself, or more often, it'll try to find a buyer. A few days before the takeover of Heritage Community Bank, we were at the FDIC office in Dallas, where they were holding a secret online auction in hopes of finding a buyer for Heritage.
The sudden and stunning collapse of Silicon Valley Bank and the ripple effect across the industry is prompting some uncomfortable flashbacks.
The last time we saw a bank crisis like this was in 1992.
Bank collapse. Regulators shutting down Silicon Valley Bank, the largest banking failure since the 2008 banking crisis.
The banks were making these bad investments.
Silicon Valley Bank, they made some really bad bets. They made some bad investments.
And losing money.
When the Fed started to hike rates aggressively, that meant that Silicon Valley Bank immediately lost money on those investments.
The housing market crashed.
Brand new fears the U.S. housing market may be headed for a crash.
And they needed a bailout.
Do you think the government should consider a bailout?
Americans can have confidence that the banking system
Last
is
Friday,
safe.
the four biggest banks in the country lost a combined $52 billion in market value. JP Morgan lost $22 billion. Bank of America, $16 billion. Wells Fargo, $10 billion. Citigroup, $4 billion. After the collapse of Silicon Valley Bank on Friday, then Signature Bank on Sunday. Trading was halted on multiple banks on Monday morning. Bank shares were in free fall for a while. First Republic lost nearly 62%. PacWest dropped 45%. Western Alliance 47%. Zions 26%. KeyCorp 27%. Charles Schwab 11%. Bank of America nearly 6%. Trading would be halted multiple times to contain the panic. So what was going on? What were people panicking about? Fear. Fear was the primary driver for pretty much all of this. When you have money, the money comes as printed by the Federal Reserve. It is not a government entity. It is a private entity that is basically owns or I don't know which one owns which. It's all the same money as the 5 or 6 biggest banks in America. So they run the Fed, okay? And they also run the banks, or the banks run them, I'm not sure. But they print the money, they give it to the bank, then they loan it at a certain percentage. It has been 0 for the last, 10 years or so. So they loan it to the banks for 0. They loan it to you for maybe 1% because you're going to start a company or it's going to build new things in your factory. You're going to buy a car or a house or whatever. And you pay 1%, they get the 1%. And when it's deposited, they keep the 1%, supposed to give it back to the Fed. Okay? That's the way it works. Now, when you have a collapse of an economy, and you have what happened in 2008, you're hearing this again, you have a liquidity crisis. People are holding on to their money. There's not enough money in the system. So they print more money. They put it out, hoping that it will stop a collapse. Well, they did this. They called it quantitative easing. I like to call it money printing. Now, they say it's not money printing because it's digitized. Quantitative easing, they put it at a 0 interest rate. They're trying to get you to borrow money because they want you to buy stuff because that makes the factories work and the real estate agents can make money and then they can spend it going to the movies or whatever. So they push all this money out in record numbers. More currency is out than at any time in the history of the world. So we're pushing all this money out. But Silicon Valley Bank was a big beneficiary, as all of the banks were, of this. Now, 2018, before the pandemic, Silicon Valley Bank had $49 billion in deposits. By 2021, they had $190 billion. Business was good. Scale. Okay, so what do you do? Bank is same as you. When you have lots of extra cash, what do? Well, you might put some in a savings. You might put it in your checking account, but you don't put a lot of it in the checking account, and you try to stay away from savings if they're not paying you anything. You also might buy some stuff that you really don't need. Then you'll buy a house or car, real estate. If you want to be smart, you'll invest it in the stock market. Or if you want to be safe, you'd put it in gold or silver. If you want the safest place money could ever go to, you fall down in front of the altar of the almighty government. I have full faith and trust in the federal government. That's what they tell you, okay? Safer than gold or silver. That's why they have inverse treasuries. So what did they do? Silicon Valley Bank, while you went and bought stuff, real estate, cars, whatever, if you could afford it, put some in your savings, they took their money, some of your savings and everything else, and they bought treasury bills. Now, this one is a little strange. They bought treasury bills. Everybody was making money. Everything was going well until it wasn't. The reason why this is strange is they bought 10-year treasury bills, and they bought it in the good times. So we all felt good. Oh, man, that's great. Yet we all also realized you can't do this. You can't print massive amounts of cash, as the Fed always does, because you'll get inflation. We couldn't afford to put gas in our cars, buy groceries. The cost of a used car was insane. The operating costs of the tech companies and startups that use Silicon Valley Bank, likewise, all that shot through the roof. The bank's balance began to tumble because the companies in Silicon Valley were not cutting any of their expenses. They were spending like they were in the good times. So they were pulling money out of the bank. You couldn't afford it, so you were pulling money out of the bank. Other banks started offering you better interest for your savings, so you pulled out of this bank and maybe went to another bank. So the Fed went into their usual autopilot mode because what is inflation? Inflation is too many dollars. They've done that. Chasing too few products. They inflate. If they've inflated, they raise interest rates. Then, when you go to get a loan, you're paying the bank. The bank is maybe charging you 8%. The Fed is charging the bank maybe 5%. Okay? So they keep their profit. You bled dry, and they get 5%. And what do they do with the 5% of cash that comes back? They're supposed to put it in the crematorium and burn it. That way they get rid of too many dollars. But the problem with this theory is you're not only destroying the dollars, if you raise the interest rates too high, then you can't buy anything, which means factories have to lay people off. The factories can't build. The jobs start to go away. So it's a really delicate math problem. So, Treasury bonds. They had all these Treasury bonds at Silicon Valley Bank, whatever. But they bought 10-year bills, which means if you're going to invest and you're going to have that money for a while, go ahead, put it in a 10-year investment. However, when you buy them at the good time, the zero interest rate applies to you. They bought bills that were almost at zero. Okay. So you're not getting any profit. The price of a T-bill, what you get in exchange, if the interest rate goes up, the interest rate goes up on these. But not if you already have them. But if I buy a 10-year bill today, I'm going to get, instead of zero, I'll get 5%. So why would I buy one at 0% today? By November of last year, J.P. Morgan addressed the elephant in the room. They warned that on top of Silicon Valley Bank's cash problem, they also had $16 billion in unrealized losses. Unrealized loss. For you, it's maybe your house. If you didn't sell your house when it was at a high, did you lose any money? You only lose money if you have a for sale sign in there and you have to sell it today. then you have a realized loss. An unrealized loss means, my house isn't worth as much today, but I don't have to sell it, so I'm not going to lose anything. Panic is the problem. If you have to sell your house, then that unrealized loss becomes a realized loss. Well, Silicon Valley, they had an unrealized loss, but because they had people pulling all their money out, they had to have money, so they started selling their bonds. And again, why would I buy a bond from them when I can get 5%? So if you're panicked, I guess, I'll make a deal, but you're going to lose 20 cents, 25 cents on the dollar. Now, Joe Biden says everything is fine.
We feel confident because I'm in charge of having like I
know, he filled me with confidence. He says that the FDIC is going to ensure that everyone gets their money, and it's not going to cost you a dime. Everybody? I read the sticker on the door, up to $250,000. That's why if I had money like the people at Silicon Valley do, I'd put it in multiple banks. But you just changed the law through executive order? Wow. The FDIC, it is something that every bank pays into, a certain amount, and everybody pays into it in case your bank collapses, then they have the cash. They are flush with cash. They only have $128 billion in cash. So, just for the 2 banks that have collapsed so far, those 2 banks need $264 billion. So half of them will get their money unless the Fed prints more. And who's on the hook for that?
Does the government need to intervene and take emergency measures because of SVB's failure?
So let me say that I've been working all weekend with our banking regulators to design appropriate policies to address this situation. What I do want to do is emphasize that the American banking system is really safe and well capitalized. It's resilient.
Can you say whether these problems were unique to Silicon Valley Bank, or can you say whether there will be other regional bank failures?
Well, look, let me just say that we want to make sure that the troubles that exist at one bank don't create contagion to others that are sound, and a goal always of supervision and regulation is to make sure that contagion can't occur.
Your counterpart in the United Kingdom has said that the government there has ruled out a bailout of the UK arm of Silicon Valley Bank. Have you also ruled out that kind of government intervention?
Well, let me be clear that during the financial crisis, there were investors and owners of systemic large banks that were bailed out, and we're certainly not looking, and the reforms that have been put in place means that we're not going to do that again.
Do you expect a deal or something to happen that can reassure the markets before Asia opens tonight and U.S. markets open tomorrow?
We certainly are working to address this situation in a timely way.
Okay, so it's like a rescue mission now. Some of the nation's largest banks are giving a lifeline to another financial institution in trouble. Bank of America, Wells Fargo, Citigroup, JP Morgan Chase are among a group of 11 banks that are going to pump $30 billion into First Republic after First Republic's bank stock nosedived. This, of course, follows the collapse of Silicon Valley Bank last Friday in California and Signature Bank over the weekend here in New York.
I can reassure the members of the committee that our banking system is sound and that Americans can feel confident that their deposits will be there when they need them. This week's actions demonstrate our resolute commitment to ensure that our financial system remains strong and that depositors' savings remain safe.
The administration's focused on public relations and twisting words.
Oh, wow.
Listen to me, folks out there. All depositors with less than $250,000 in the bank are covered. You were covered before this weekend. You've been covered for years. Everyone is covered. Okay, what they're trying to cover is the fact they bailed out billionaires in Silicon Valley, and it has messed everything up. Let me tell you, they have blown it, because now she's got it. Senator Langford said, listen, if a bank in my community went under and people had more than $250,000, would they be bailed out? She did the him and the hawing thing, and there's got to be this, and there's got, no. No. The answer is no. Silicon Valley was bailed out. Bigwigs in New York were bailed out. There's a thing called the discount window, where banks go to get money from the Federal Reserve. This week, they got $153 billion. The week before that, $4 billion. The Federal Home Loan Bank helps assure banks, last 3 days, not counting Thursday, Monday, Tuesday, Wednesday, $250 billion. A record $112 billion on
Why
Monday.
did they need all that money?
Why do you think? All the money. They're worried. Federal Reserve extended FDIC $142 more billion. And they just created a new fund for banks. So let's say you own bonds that mature in 10 years, but right now at $100, but right now they're worth $70. You can go to the Federal Reserve and get $100 for it. By the way, ultimately that could cost us $2 trillion in loans. Silicon Valley Bank was a bank of venture capitalists. It had no real connections, you know. And when President Biden and Janet Yellen says small businesses needed to meet payroll, that is a lie. Not a lie that they needed to, a lie that they were at risk. Again, 95% of the small businesses have less than $250,000. They bailed out billionaires, and we are intended. This weekend is going to be scary. President Biden should have come out Sunday night and said, 90%, 99% of Americans, you are covered. Keep your money in your community bank, and we've got you covered.
Why didn't he?
Because his political donors got out there. Bill Ackman got on Twitter. They called him up, said, you must bail us out. This is Silicon Valley. This is the venture capitalists. You know how much money we put in your campaign? You know what you owe us?
Yeah.
Figure out a way to paint this as a way of bailing out the small guy, but save us now. And he did.
And I may want them to.
Guess who's got to pay for it?
Exactly.
You do. Everybody with a community bank account, everybody with a small bank account, everybody with a bank account in America is paying once again to bail out the billionaires. The money that they put, Silicon Valley Bank and Signature Bank. This is what you could have gotten, progressives. $24 billion in student loan bailout, $85 billion to repair school infrastructure, $20 billion for paid family leave, $40 billion for child care, $24 billion for dental for seniors, and $22 billion for 2-year free community college.
Go look at Langford. He talks about SVB having a large number of Chinese investors directly connected to the CCP. And he asked, will people in Ohio banks be bailing out Chinese investors or depositors? Her response, uninsured investors will be made whole in the bank, and I suppose that could include foreign depositors. She confirmed that could happen.
Maria Bartiromo this week has been talking with sources who have a list of who some of those people are, those Chinese companies. And remember what we've been saying this hour, the CCP, Communist Chinese Party, definitely has its claws in everything that's operating business-wise over there. So basically, we are paying off some China exposure financially. We're willing to insure them, and I'm betting it's above $250,000 in account.
About President Biden's bailout of the 3 banks that went under. We had too many undeserving people at the top in America getting bailouts. And we had too many undeserving people at the bottom getting handouts. And the rest of America, most of America in the middle, was getting the bill. Now, President Biden chose to bail out 3 of our banks. It was a bailout. You can pretty it up any way you want to. And you can put perfume on a pig, but it still smells like a pig. This was a bailout, except for the people who own the stock in the banks and their unsecured creditors. President Biden and his regulators guaranteed that nobody affiliated with these banks would have any losses. And he said, that's not a bailout because money's not being provided by the American people. It's being provided by all the other banks in America. Well, Mr. President, as you know as well as I do, there is no money fairy. There isn't anything free. Anything free, somebody had to work for it. by taking the hit, all the banks in America now I'm referring to, banks are taxpayers, that's point one. Point two, but those banks, all the banks in America that are going to have to pay for the president's bailout, they're just going to pass on those costs, including but not limited to their depositors. And last time I checked, most depositors in banks in America were taxpayers as well. But he has set up I think it's a $25 billion fund that other banks that are in trouble can borrow from. And this fund, he says, does not come from the American people. It came from the banks. Once again, the costs of it will be passed on by the banks to the depositors, to the taxpayers. But this $25 billion fund that banks that are in trouble can borrow from is set up as follows. The banks can borrow money as they need it, and as collateral, they put up their securities. Except when you read the fine print, you find out that the securities that the banks put up as collateral to borrow money from the American people are not what's called mark-to-market. They aren't, the securities are not put up at their real value. They're put up at the value for what at the time they were purchased. Silicon Valley Bank. All the bank failures were an abomination, but I think Silicon Valley Bank is symptomatic of the problem among all three. SVB, as we call it, Silicon Valley Bank. First of all, Silicon Valley Bank was not broke. It was not an insolvency problem. It wasn't insolvent. Silicon Valley Bank had a liquidity problem. I mean, here's what happened. Silicon Valley Bank took in a whole bunch of deposits on which they were paying an interest rate. And then Silicon Valley Bank took that money and went out and bought a bunch of securities, paying a higher interest rate than Silicon Valley Bank was paying the depositors. You say, that's pretty smart. There's just one problem. The securities that Silicon Valley Bank bought were very sensitive to interest rates. And as interest rates went up, and they have, the value of those securities went down if Silicon Valley Bank had to sell them. And sure enough, Silicon Valley Bank got itself in the position of having to sell them because a lot of its depositors got scared about the bank's position and other reasons and said, we want our money back. And Silicon Valley Bank didn't have the money because it had to go sell these securities at a loss. And that's why it had a liquidity problem that could have been fixed. It wasn't broke. Let me say that again. President Biden's bailout could have been avoided if one or more of three things had happened. Number one, if the management of Silicon Valley Bank had known the difference between a banking textbook and an LL Bean catalog, Silicon Valley Bank would have never bought securities that are so sensitive to interest rate without hedging that risk. If you buy securities to back your deposits that are very sensitive to interest rates, there are other securities you can buy to hedge that risk so you don't take the risk. The regulators didn't catch it. There's been a lot of talk about Silicon Valley Bank wasn't being regulated because of a bill passed back in 2018 or 2019. That's not true. Silicon Valley Bank was heavily regulated. It had to file regular reports with the federal banking regulators. It was subject to stress testing. It was subject to liquidity stress testing. All the regulators had to do was read the reports that the Silicon Valley Bank was submitting, and they would have seen the problem. You know who saw the problem? Way back in November and October, stock analysts in the private sector that were covering Silicon Valley Bank warned way back last fall. They said, you know what, this bank is setting itself up for a potential liquidity problem. The private sector knew it. Where were the regulators? Where were they? You couldn't have found them with a search party. I guess they were asleep. But this whole debacle could have been avoided if the regulators had just done their job and stepped in and said, Silicon Valley Bank, what you're doing is dumb and you can't do it anymore. I think the bank went under on a Friday, as I recall. The Federal Reserve, the Secretary of Treasury, the head of the FDIC, and all the other regulators allowed the bank to go under. Instead of getting on the telephone and calling other banks and saying, I've got a situation here with Silicon Valley Bank, it's not insolvent, it's just illiquid, we want you to buy it. That's what normally happens. That's all the regulators had to do. Now, why didn't they do that? There's been a lot of talk about, well, they had an auction for the bank and nobody wanted it. That's not true. There were buyers. But the problem was that the people at the FDIC do not like bank mergers. And so the folks at the FDIC stalled and restalled, and then we had mass panic.